Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. There had been here two main patterns on this daily chart. One had been driving the market higher longer term and one pressing lower in the shorter term. Both of these patterns are now broken and we've had some resultant successful fallout from the subsequent moves lower. The first was a very shallow March to early June bear channel. It was not an ideal pattern, but it did fit with the recent action, just about. It is also below what had been some considerable congestion formed over March and early April between roughly 1170 to 1193. This move lower was all prompted by the weekly key reversal down made 7 weeks ago, which formed the peak of a small if imperfect head and shoulders top, or even a nascent diamond topping pattern. The follow-on move lower from this down reached the targets for both the head and shoulders top and the diamond pattern, making a key break below lower 3.5 weeks ago, not only below the December 2020 lower 1143, remember that level, it will come up again, but more importantly breaking down below the main showrunner for this market since August last year, the dark blue lower time, currently 1159 even, of the second major pattern here, a consistent big picture item, the dark blue December 24 to August 25 bullish Andrews pitchfork. I said on this move lower 4 weeks ago, and I quote, "This now leaves not only this pattern compromised, but it opens the way for a test of the gold long moving average below, currently at 1126.5. The first time since the start of January this year, as well as possible tests of the 61.8% absolute Fibonacci line at 1105 3/4, and the pair of 50% Fibonacci lines at 1100 1/4 and a 1098 even." And that's the end of the quote. Since that statement, prices have dropped down to the long moving average and started to stabilize, potentially for either a further move lower as a possible bearish halfway hesitation or a bottom of some sort. It is too early to say which will be true right now. I also added 3 weeks ago, and I quote, "With this move down, we can now look at the whole March to date action as a possible wide double top, Adam and Eve type," end of quote. I added a week prior to this, so 3 weeks ago, and I quote, we have even today gone so far that I feel obliged to lay out some targets for this pattern of a primary target X down in the 1114.5 zone, just under the gold long moving average, and a secondary hard to reach target X1 down in the 1078.5 zone. This could be quite a large move lower as there is limited supports below now, so watch carefully. 3 weeks ago prices reached the primary target X, and whilst it may be that the gold long moving average is acting as a tractor, it's also worth considering 3 other supports below that might be obstacles in the way to target X1, and I've already mentioned they are first, and I think possibly the strongest, the 61.8% absolute Fibonacci line at 1105 3/4. Second is the 50% Fibonacci line of the August 25 to March 26 move at 1100 1/4, and third is the 50% Fibonacci line of the May to August 24 move at 1098. Now these last two are close enough together that they can be regarded as, I think, one congestion between 1098 and 1100 1/4. However, even looking at them this way, I still think the 61.8% absolute Fibonacci line is the greater support and obstacle to reaching target X1 below. This brings me to my final point. It's an open question that deals with the main action over June between the 61.8% absolute Fibonacci line and that December 2020 low above at 1143, the one I asked you to remember. It's whether to regard this action as either a hesitation or a basing action. It is early as yet, but the longer the market stays within this band, the greater is the chance that it may be a basing action rather than a hesitation. So watch carefully. Chicago soybean meal. Between January to early June, the market had moved up nicely within the main pattern here. A bull channel formed between the lower and middle tines of the late September 25 to mid-January 26 bullish shift pitch walk. However, 3.5 weeks ago, prices broke down through the lower tine, which is currently at 325.10, as well as below the flatlining mauve medium moving average, which is currently at 316.5, and the congestion between 309.40 to 311.20, and most recently below the slowly rising gold long moving average, which is currently at 308.60, and even testing below this the important 50% Fibonacci line of the 25 to 26 move at 302.10, breaching it but not as yet breaking it. I spoke of such a move lower 4 weeks ago when I said, and I quote, "Below this, well, apart from the congestion from January this year between 293.5, the 50% Fibonacci line at 302.10, well, there is nothing much, and I should say with the overhang of the market since February this year, I could easily see that being tested." End of quote. Thus, this move down from what effectively was a January to early June bull channel left us with some targets below, of a primary target in the 305.20 zone, which has already been reached, and a secondary harder to reach target X down in the 292.90 zone. This secondary target X would be a significant drop close to the lows of this year, though not perhaps as hard as it first seems, as there is little support apart from the congestion from January and February down at those levels. It all depends if prices can punch down and stabilize below the 50% Fibonacci line at 302.10. If we do, watch out for the possibility of a further move lower, with the whole late May to day action looking like a possible bearish halfway hesitation. Right now, it's an open question whether the action over most of June is a hesitation before a move lower or the start of a basing action. I do know that the longer we stay down here, the greater is the chance of it becoming a basing action, so watch out. This leads me to my final point, and this commentary would not be complete without my discussing a portion of my commentary which I have repeated for 161 weeks, so for 3 years now. It is to do with the annual key reversal seen here at the end of 2023. I said back then, and I quote, "And I only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023. I've been living in the shadow of this pattern ever since." End of quote. I've also added ever since, and I quote, "If there is only one thing you take away from any of my musings, let it have been those words." End of quote. For 3 years, the shadow of that pattern has darkened the skyline of this market ever since. And I wondered if prices were now finally sending that shadow to oblivion. Once again, it does not seem so, as we are still significantly below the close of 2023. Chicago soybean oil. There is one pattern here that has defined moves higher this year, even when it was being thoroughly tested. Is the bright pink March to August 2025 bullish Andrews pitch walk. The market today just below the bright pink middle time, which is currently at 67.68. And the rising mauve medium moving average nearby, currently at 68.92. Most recent pattern formation was the turn of May into June horn top. That is part of a mid-April to late June lopsided double top. This latest move lower was prompted by the horn top, negating an earlier weekly key reversal up. The primary target for this double top was reached 2 weeks ago, but the harder to reach secondary target X, down at 64.85, is still there, though target X is stuck in the lower end of congestion dating from March this year. Now, having some doubts if prices will drop all the way there just yet. None of this retires my last statement on this market for the past few months, but it did temper it a little. I said in the past, and I quote, "I think for this market the question is not whether the market is bullish or not, but how bullish does this market choose to be?" This is now the 6th week, and the bullish incentive has indeed been heavily dampened, but still not as yet completely extinguished. You only need to look to the pink middle tine or the whole bullish pink Andrews pitchfork to see that, along with its close association to the pink lower time below, currently at 58.80, running right from the start of December last year, is the rising gold long moving average, currently at 60.08. However, there is what last week was a developing factor and is now a factor set in stone, which may have a significant impact on this market. It is the monthly key reversal down in this market seen in June, for all the possible implications that may have. We should now point out that this monthly key reversal down is not alone, as we have seen similar monthly key reversals down in most of the other oilseeds and veg oils. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.